Assalamualaikum warahmatullahi wabarakatuh, and hi everyone, my name is Fasha Husna, and today I would like to share with all of you about the positive accounting theory. But before I proceed further with the positive accounting theory, I would like to first to share about the introduction and definition of this topic. So basically, accounting is the language of finance, giving managers and investors a standardized system to present the finance of a company in a way that is transparent, consistent, and informative. All of the different accounting rules are not arbitrary or naturally occurring. Today's accounting system are the result of carefully constructed applications of theories that seek to find the best and most economically accurate methods for representing a company's performance. So, positive accounting was first developed in the late 1970s and attempts to describe and explain actual accounting practices. If you ask a layman to describe what he thinks accounting is, his description will probably be closer to positive than normative accounting. So, under positive accounting, an accountant will collect and look at real data such as a company's revenue and expenses for the past year and then derive actionable conclusions based off the financial numbers. As the Motley Fool observes, positive accountings view a company as the total of the contracts they have entered into and seek to maximize the efficiency of each contract. So, positive accounting strives for objectivity, and most people value objectivity. But from another perspective, positive accounting's quest for objectivity causes it to set some very subjective parameters for making assumptions. For example, this theory assumes that business owners act out of self-interest and is a strong believer in the heavily criticized efficient market hypothesis. The failures of the market in 2008, when investors and accountants failed to realize that financial securities were losing value before it was too late, is an example of the failure of the EMH. Next, we will proceed towards the level 2 positive accounting. Basically, there are 3 levels of positive accounting. The first one is positive or positivist theory that refers to the branch of theorizing that values objective, value-free empirical research. All scientific research is positivist, known as the scientific method. Second is positive accounting theory is the branch of accounting theorizing that makes use of the positivist scientific method for research. And last is positive accounting theory is a specific theory within the positivist accounting theories in accounting. Therefore, positive theory, positive accounting theory, and positive accounting theory PAT are all related, but they do not refer to the same thing. Make sure that you know the difference. Next, we move to the hypothesis of positive accounting theory. Basically, there are 3 positive accounting theory hypotheses. Watts and Zimmerman have formulated 3 hypotheses with regard to positive accounting theory, and the next defines the opportunistic form of this hypothesis as follows. The first one is bonus plan hypothesis, the second one is debt covenant hypothesis, and the third one is political cost hypothesis. So, for bonus plan hypothesis, it is maximize compensation. All other things being equal, managers of firms with bonus plans are more likely to choose accounting procedures that shift reported earnings from future periods to the current period. Managers of firms with bonus plans are more likely to choose accounting procedures that shift reported earnings from future periods to the current period. By doing so, they can increase their bonuses for the current year. Moving towards the second hypothesis, the debt covenant hypothesis, it will minimize problems with creditors. All other things being equal, the closer a firm is to violation of accounting-based debt covenants, the more likely the firm manager is to select accounting procedures that shift reported earnings from future periods to the current period. The closer a firm is to violating accounting-based debt covenants, the more likely the firm manager is to select accounting procedures that shift reported earnings from future periods to the current periods. By increasing current earnings, the company is less likely to violate debt covenants and management has minimized its constraint in running the company. Moving to the last hypothesis of positive accounting theory, the political cost hypothesis, it will minimize political heat. All other things being equal, the greater the political cost faced by a firm, the more likely the manager is to choose accounting procedures that defer reported earnings from current to future periods. The greater the political cost faced by the firm, the more likely the manager is to choose accounting procedures that defer reported earnings from current to future periods. High profitability can lead to increased political heat and can lead to new taxes or regulation, especially for large firms, which may be held to higher reporting standard. Basically, the theory then predicts that managers will choose accounting policies to further this objective. We cannot infer fraudulent and unethical behavior here. Rather, the accounting policies that management choose are typically all within GAAP. However, there is considerable room to manage reported net income under historical cost accounting. This can be done through choice of amortization policy, choice of full cost versus successful efforts for cost of oil and gas exploration, being conservative or optimistic about provisions for warranties and bad debts, and so on. It is obvious why financial accounting policies have economic consequences. New standards or the reduction of acceptable accounting policy alternative may interfere with management attainment of its objective. Next, we move to the how to achieve positive accounting theory. So, first one, to achieve the positive accounting theory, we can do by changing accounting policies. Second, by managing discretionary accruals. Third, timing of adoption of new accounting standards. Fourth, changing real variables in terms of research and development, advertising, repairs and maintenance, and lastly, SPEs that can be referred to Enron case study, capitalized operating expenses that related to the case study of WorkCom. Last but not least, we move to the conclusion part. Positive accounting, most typically utilized within data collection and bookkeeping, takes an objective approach. Using a company's physical transaction history, it analyzes and discerns the ramifications of these expenditures. It compares revenue against expenses to figure out if and why an enterprise is running at a net loss or gain. Building from this knowledge, the theory anticipates how a business will handle future transactions. For example, if an organization has had a highly successful financial year, the next year they will have the financial stability to boost investor dividend payments. From this, positive accounting theory will deduce that corporate growth causes an increase in shareholder remittance. Positive accounting theory is an attempt to understand why and predict which accounting policies a firm will use. A firms make policy choices to minimize contracting costs, and accounting policies do this significantly, but firm structure, the operational environment, and corporate governance also influence these policies. Accounting policy choice should be somewhat flexible so management can respond to unforeseen contract outcomes. However, one must be aware that with flexibility comes the possibility of opportunistic behavior. The big picture is that changing accounting policies will draw a reaction from management. New policies that decrease firm flexibility in terms of accounting policy choices or interfere with existing contracts will receive strong reaction from managers. So, that's all from me regarding to the topic of positive accounting theory. Thank you for listening, and I hope that all of you will understand and do more research to understand deeper about this subtopic. So, thank you.